Hopefully, it'll be more beneficial to you to hear my words today. I think it's important to realize that I don't believe that the oncoming light is the train. I believe that the markets as we sit here today are in the early throes of making what could be a historic low. And when I say historic low, I don't mean historical in the sense of 20 or 30 years. I only include modern history because the markets have grown so significantly that an ending stocks figure now is not as significant of a reading as maybe what we had years ago. As I look out here today, I look back to my presentation last year, and what I look at is what threatened to be a multi-year bear market in grain prices. And 1 year hence, the economy has underperformed. Production was large, but not as large as was feared. So the potential for a multi-year bear market has dissipated. Little minor hits in production have been seen in the U.S., Europe, starting to see some problems with the bean oil and palm oil production. As I look at the marketplace, I do a top-down analysis. 25 years ago, a grain analyst was a grain analyst, and he didn't care what happened in other markets. He didn't care what happened in energies and currencies and the stock market. I view this top-down analysis as something that I'm always aware of in my day-to-day analysis of the grain markets. And so you look at it, the economy, and then you look at the oil market, and then you look at the currency markets, and then you look at China. And any one of those particular items on any given day could be the primary driving force of the market. You also have to look at parallel markets because of substitution in the feed mixes, because of alternative demand elements. All these items come into play, and at any given time, one of those could be the driving force. But I always feel that I'm a classic fundamental analyst at heart. You have to look at how much is on the ground, how much is being consumed, and you have to understand the patterns that are unfolding within those particular elements. So I say that supply dominates until supply no longer dominates. Now that sounds repetitive, but it's true. The markets will focus on that extra supply, and they'll even discount the beginning threats against production, and they will discount evidence of growing demand until a fulcrum point or a pivot point in the marketplace. And if I had to predict as I'm standing here today, I would predict that low point and that fulcrum point to perhaps take place between now and the end of the year, and maybe at the latest in January. So I hope as I go through my presentation, I can justify why I feel that way about the marketplace. So if I put the presentation in gear here, those that say that we're in the beginning of a downtrend in prices need to look at the cost of production. And I see Wall Street and other predictions that we're just beginning the bear market in commodities, or that the physical bull market in commodities has ended. And I look at the cost of production and I realize they're wrong. I realize that we're getting near the end of a correction in commodities, not the opposite. So it's not a downside signal, it's a warning that the bottoms are coming. And I always like to say in the grain markets that the markets like to bottom in the period of highest supply. So we've had our South American crop, the US crop is coming in, Europe crop is coming in, and we're now beginning to start the next production cycle. So if you look at 2015 January and 2016 January, you're going to find a little bit tighter supply, and you're going to find that demand in 2015 was really better than what the market had projected. Now, Goldman Sachs came out with a prediction of $20 oil. I think that's wrong. When you look at the IEA and the EIA, which are two quasi-governmental entities, I don't mean to pick on them, but they tend to be very statistically orientated and backward-looking. And so recently, the International Energy Agency has predicted that it'll take several years for the price of oil to rally. So just remember that, because more than likely that forecast is going to be wrong. And again, the Energy Information Association in the US is once again heavily statistically orientated, and all they do is project. They say if today's production is X, then 18 months down the road, supply is going to be much greater. They cannot, with their charters, put any estimate in for an improving demand or any kind of supply shock. And so we all know that it's virtually impossible to go an extended period of time in almost any commodity market and not have some kind of surprise development. So I don't believe that. Also, China's been this huge concern for the entire marketplace. And there's markets, maybe 10 markets, that have a 90, 80% type of influence from what goes on in China. If the GDP is down, the copper market gets hit. If the durable goods sales and capacity utilization in China is down, the copper market gets hit. And you can look across these markets, soybeans in particular, as they are a huge importer of beans, and you find out, and I saw during the August currency crisis that China had, that there were concerns rampant about what was happening in China. And one analyst said they only had $3.5 billion in currency assets within the central bank. Now that's the largest, that's 20% of the world's total central bank reserves of capital in one country. And so the trade was overwhelmingly interpreting that wrong. That China, if you're going to worry about something, you should worry about the United States, who instead of having a surplus of capital, and it has a huge debt. And I like to say this, the U.S. has about as much debt as China has cash and marketable securities and foreign real estate. And so for that reason, I don't worry about China. Next item up, car sales. Who would have thought that car sales following the subprime crisis would have been so strong? And in the last month, the U.S. has posted what amounts to be almost a record year in car sales. In China, the sale of SUVs has exploded. So when we want to talk about how much food China is going to consume, and we see these heavy durable goods purchases, I know it's a two-tier or bifurcated marketplace in China, but the top half of the industry or the consumer is doing very well in China. Also, the trade is to China is where? Exports to the U.S. So why is China doing badly? Well, because the U.S. did not recover as quickly as we thought. And if you look at the trade balance since February, we've seen 14 billion extra in the amount of exports going from China to the U.S. So their stimulus, their recovery potential, they're a mirror image of the U.S. economy. They want to be a demand-driven market, but they're not to that yet. They're still heavily reliant on manufacturing activity inside the country. Next item, the El Nino. Again, this is a supply-side problem which is not yet being factored. I don't believe there's a weather premium in grain prices yet because of El Nino. Some might argue that prices would have went lower if we had not had the El Nino influence in the marketplace. But as I sit here today, we're watching 6 major cities in both Indonesia and Malaysia, and their rainfall precipitation percentages are running 70 and 80% below normal. So the Pacific Oscillator, which is the overall statistical indicator that measures the strength and the duration of the El Nino, is still very strong, and it's signaling a record level. The precipitation is starting to decline in those areas which should decline in the early stages of an El Nino. But as of yet, we're not pricing that. Markets work, but they're not as efficient as can be expected. And by that light, the low prices do cut the supply, and they do increase demand. They just don't do it instantaneously. Moving on. So the negative influences right now, if you see inflation, we have all kinds of PPI and CPI readings that are in negative categories. So I would tell you that the U.S. and most central banks have no ability to control inflation. There's negative inflation when we're not growing, and there's inflation when we're growing, and there's no in between. We can't control inflation, but when inflation starts to come around, that shows you that growth is taking place. So watch those PPI and CPI and those import and export prices when they're released. Also, on the 15th of every month, around the 15th of the month, watch the Chinese import data and watch the export data from China. Those are the new normal fundamentals to watch. So as we look out, the dollar's strong, which is negative to physical commodities. It's negative to the U.S. export of commodities, and so it keeps the heavy supply in the U.S., which gives off the impression of bad demand. The energy complex is a good example. Many consumers throughout the world have their crude oil priced in dollars. So the U.S. has got this huge windfall from lower oil prices, but that same windfall has not spread to the Eurozone and other areas. So the U.S. is the head car on the train. We have a train theme going here. The train has come down and it's now starting to go up the hill, and the back part of the train, China, Europe, and other areas are still in the midst of coming down the hill. So the U.S. will lead us out of this, but the dollar and its ability to rally off a U.S. rate hike is going to make the outlook for demand and the pressure on commodities acute or significant over the next 2 months. So don't forget that. Two other elements, though. China, I don't know how many people have been to China recently, but yesterday in the New York Times, there was an article from one of the state newspapers criticizing the level of pollution. Now, this is, first of all, for a publication to criticize the government in China is a significant development, but it's also telling me from the times that I've been there in the last year, year and a half, that things are getting much worse. And I would predict, as I sit here today, that over the next 10 years, as many as 300 million people might have some kind of lung disease because of what's going on. So there is a huge influence from China. And I would urge you to go and look at the 5-year plan from China that they release and they try to live to very definitively. But the amount of money that was allocated to clean the environment was larger than what the U.S. spent on the TARP program to save the markets during the subprime crisis. So there's a huge amount of effort. And after a 6 to 7 year limit on ethanol production, they've now reversed that rule, and we're starting to see ethanol flow. So whenever I look at the clean air problem, the quickest way to remedy that in India and China is to implement ethanol into the equation. India, 3 weeks ago, the Supreme Court of India advised the Delhi government that they had 3 days to comply with the national pollution control rules. I was talking to a major supplier of ethanol, and I said that India was going to have to begin to use a lot of ethanol. And the question was, how did I know that they were interested in that? And I said, well, you just told me that you were going to meet with officials. So they are under a quick mandate to try and do something about the pollution. So India and China will either make the ethanol or they will purchase the ethanol. I feel that they will purchase a lot of ethanol as they're trying to get their internal ethanol production up and running. So it's a very important combination. But again, supply dominates until it doesn't. Once demand comes into play, it's just not as anxious of a problem when you can't guess. In the middle of a drought, we can't determine within 10 or even 15% what the losses will be. And when we see these large export commitments and sales that are released by the USDA on almost a daily basis to unknown destination and to China, and you add up those over time, it slowly and gradually grinds the price higher as we move forward into the future. And then if you get an El Nino influence on top of that, that's when the markets really start to accelerate. So if we see a $3.40 to $3.60 price in corn in the next several weeks and months, I will be very shocked, and I would suggest that'll be a modern era opportunity. If you're a buyer of corn and you see those kind of pricings, you need to try and extend your coverage forward. You need to hedge against the price coming off the bottom. Why? It's significantly below the cost of production. It'll be tremendously reactionary to El Nino. And the next item is look at the bean oil and palm oil markets as the leading indicator of El Nino. So China has more money than people think. India is the strongest growing economy in the world, and they're going to be the people that are stepping up to buy this commodity. And I remember speaking to the Indian ag minister, and he was convinced that the exchanges in commodities were inflating the cost of food for India. And I said that India was lucky that they had these signals in the marketplace, or during the last drought, the market would have made prices probably twice as high. Now that's a strong statement. If El Nino hits, it would not be unusual for bean oil to double in prices over the next 12 to 18 months. That sounds like an aggressive prediction. I beg you to go back and look at a 5 or 10 year chart. Just look at a 5-year chart of bean oil. And remember that I said that, because that's not that aggressive of a prediction. So as we're going forward here, China's financially strong here. You go through and you find out what they're doing. Look at what China does, not what they say. Don't believe the stories about real estate problems, because the amount of buying that they're doing, you'll see in several slides here that they are still purchasing a tremendous amount of commodities, and the market is guilty of looking at the percentage of increase for this month versus last year. That's like if a person in soccer had 4 goals per game last year, and he's only having two goals per game this year, his performance is no longer any good. And China's the same way. They're put in a different position. So, as I said, top down, oil. What's oil got to do with it? Well, oil is the driver of all things grains because of the biofuel input, and also because oil has a huge input on where prices are inflated or deflated. So this perfect storm of having too much supply, adverse currency market action, a 50% reduction in the price of oil, and impending interest rate hikes is a really toxic, negative, short-term element. But again, this will not last. You'll see China in huge purchases of even corn if this unfolds. So I look at the chart here and it shows, look at this oil consumption. Now there was a minor downtick following subprime. So the worst disaster in modern history, you know what it resulted in? We only had a 1 or 2% rise in total world energy use. So when the worst of the worst hit, we still saw oil consumption from one year to the next reach a record high. And if you remember, following 2008, there were a number of projections that we would never reach record demand again, that we had peak oil demand. That's not been the case. Here's what's in motion. Baker Hughes, the rig count, down 10 weeks in a row. We have seen oil stocks in the United States drop by 400,000 barrels per day. And I would maintain, this was a forecast made by the EIA and the International Energy Agency. They predicted this huge drop following subprime. It never happened. And again, I'm not picking on them. I'm just saying that they rely on backward-looking analysis. So as we're going forward here, it's not surprising that the U.S. is producing a lot more gasoline. But my point is the following. The U.S. is the major swing producer of oil, but we don't have the products. We don't have gasoline. We don't have diesel that is going to meet this ever-growing global demand. All of the swing production of oil is basically in the United States, and we don't even have a legal capacity to export oil. So we have to export the products. So what's already happening is the production of ethanol and the export. We even exported ethanol to the United Arab Emirates and Brazil. Brazil was supposed to be the lowest cost ethanol producer, but yet they're importing ethanol from the United States. What is that telling you? Well, look at world vehicle sales. I talked about this last year, and it continues to outperform, and some people will say they're more efficient vehicles, but every year we're adding 60 to 70 million new vehicles globally. And a large percentage of those people last year were riding a bicycle, walking, riding a moped, the little three-wheeled tuk-tuks, and now we're seeing SUVs bought in China. So this is important when it comes to the energy complex. Demand in the U.S. almost went to a record level this summer, and there were some 39 weeks in which demand this year was higher than last year. So this is very healthy growth that we're seeing. So when we look at the grain markets, the oil picture is what? We're down at a level here in which tar sands oil, some anthracite, there's several layers of production that cannot survive and will not survive if this price structure remains in place. Already, total global exploration and development costs have went down by 21%, okay? We have never seen that in history. Yesterday, we had an OPEC member openly criticize OPEC for the quotas and not respecting the quotas that are in place. So the beginning of a major bottom is in place in the oil market. But again, I have to say, if I made an analogy, the price of oil is like a ball filled with air that's held underneath the water. If you let it go, it comes up very quickly to the surface, but it doesn't float up into the air. So just because we're going to reject $40, $45, and $50 doesn't mean that we're going to begin an uptrend. Again, you'll need a supply side threat in order for us to go back to the $80 level. But the important thing for the grain markets is the period of deflation has come down, and now it's going away, and the lack of competition for ethanol will also be improved as the oil prices recover going forward. Now, on the average gallon and liter of ethanol, you have a 90% amount of unleaded fuel and a smaller percent of the biofuel. So the most important influence on ethanol production and profitability and the consumption of corn, wheat, and other items to make that ethanol is the price of oil. In biodiesel, 80% of the price structure is determined by the oil market. So it's important and very critical that we see this supply and demand fulcrum. I would suggest last year when we were talking, the supply pendulum was way high and demand was bad. Now we're seeing at least an even and perhaps a slight upward tilt with demand overcoming supply in the corn market. And that's why I think it's important to go forward here. This is the speculative positioning of corn, wheat, and beans on the Chicago Board of Trade. So this is the people that have the ability to be long or short. It's the funds, it's the speculators. It's not the commercials that are forced to hedge in one direction or another. These positions can go in either direction. So when you look at this, you see an extreme bullishness registered at the top of the chart there in the last 5 years, and you also see an extreme negative. And I don't believe that we're going to see a record spec and fund short in this particular chart in the next 4 months, but we could see this add significantly to the short side positioning. And again, I remember making a call in 1998 that a low was in the gold market. And in my comments that day, I said, you may see such a large short covering rally that you won't believe it. And back in 1998, a $70 rally took place in the next 2 days, and it was because everyone that could be short gold was short. The central bankers were selling gold. The speculators had a record position. The banks were loaning gold. The miners were selling gold out of the mine as a hedge. So you had 95% of the trade leaning on the downside. And so when you see the speculators net short, certainly other people can come in. Producers, which are a small percentage in the futures market, cash sales can come in and they can knock prices down, but it's not a sustainable bear market. What it does is it makes it much more risk tolerant for us to pick a major bottom. If you have as many players as you can see visibly short, that reduces your risk of getting long. And so I think it's important to analyze that stuff. So what we don't know is what's the duration of this oversupply? Because that beach ball, the ball analogy is very important for grain prices. If we go down too much, And again, if we were to see a 20 or 30 cent decline in the price of corn, I would think that would have to come within a relative close proximity of 2 days in which the USDA came out with a report like yesterday. The Dow Jones was down 500 points in the day. The dollar was up 200 or 300 points. And the Fed raised interest rates. So that you have this broad-based, risk-off selling wave. So we have both the outside and the inside factors pressing prices downward. So we don't know the duration of this, but I think we do know what prices lows may be. So I think I could come much closer to predicting a low in terms of price than perhaps the timing. So we get to a price that's substantially below the cost of production. We see China come in with large, and again, large purchases, perhaps record purchases or sales to unknown that are coming across the wire in a day-to-day basis. We see large ethanol purchases from the U.S. We see large ethanol purchases from Brazil. And at that point, I think it signals a bottom. So we also don't know, when do we shift? If someone asks you, how many people would like to hold physical assets? How many people would like to hold gold? There'd be very few people in this room. Your complaint would be, why would I buy gold or physical commodities when we're going to see the Fed and possibly the Bank of England and possibly the ECB raise interest rates? I wouldn't want to buy physical commodities. And so when that shift comes, that adds to the upside in the grain markets. So we don't know what the El Nino influence is going to be, but China and India is much more important in this El Nino cycle than they were in the last significant El Nino cycles. Why? We didn't chart their production. Their imports were insignificant. Now their exports in some cases are significant. So if you see that particular supply removed from the world equation, it's very important. It's as important as South American production and North American production and European production. Keep that in mind. So since November, imports into China have reached 11.7 million. It's up 3% from a year ago level. So we see some of this already starting to unfold here. And as I look at it, going forward into the 2016 crop year, the first significant focus came in a month and a half ago when there was a prediction of a 20% reduction in South American corn production. That's why I'm bullish corn prior to soybeans, because we may have more soybeans but less corn in South America. So this is spread out: Argentina, Venezuela, and Brazil. Okay? The Brazil mid-crop of corn may be affected by El Nino, but the early crops, soybeans and corn, might actually be helped by the El Nino. Because if you go back and look historically, there are large rains in parts of the Brazilian production area. And that is another reason why I'm negative in the next 3 months into January. Because it may look like, from the uninformed, that large rains in Brazil, the El Nino and dryness threat is certainly not going to happen this year. I won't say that the market in the know will discount that, but when you look at this, this is significant. And what I want you to note in most of these charts is we have this major bearish psychology, but if I look at the production, corn, wheat, and soybeans, and I look at the stocks to use, and I look at the use, many times we're almost matched. So over the last 3 years, the production of corn has almost equated to or been underneath the amount of production. So the consumption and production are right close to each other. So in the worst case scenario, we're not going to build supply anyway. Well, here's the second critical change. Last week, China was thought to have seen drought damage and too much rain damage at the end of their crop. Let's go back over the last year. As I sat here last year, there was talk and fear of these excess supplies inside China. I said in the Chicago Global Grains Conference that I thought that you would see significant imports of ethanol by China, and I also debunked or challenged the idea that China had these excessive stock levels. No one knows what they have. Many people think it's a lot. But what we found out is that Beijing continued to hold record high corn prices. So for 4 or 5 months in 2015, the trade was pointing to record stocks, but the domestic price was at an all-time high. So that doesn't mix. Does it mix with you? That you have way more supply than you've ever had, but yet the price is higher than you've ever had it. It doesn't mix. And I know the Chinese government was attempting to make the local users use their corn instead of importing from abroad. And they achieved that. But now what's happened is the crop has possibly come down as much as 21 million metric tons, and a certain portion of the corn that's inside China is of unconsumable for livestock, and therefore it might have to be used in ethanol. And so when I look at that, the bottom item here is Dalian prices reacted, and the government came in and bought some corn. So again, how do we, within 6 months of them saying they have record internal stocks, that the government comes out and buys 50, 60 million metric tons? Well, the real story is that they need the corn. The bottom story shows how important that is. If they have 21 million metric tons less than what we anticipated, that's half of what the U.S. exports a year. So is that important? Yes, it's important. That's not quite twice what the Ukraine exports. But again, Ukraine is a hugely important component in the corn market in 2016. Why? Because China's been nipped. The U.S. production, or the corn production in South America, is going down. So what happens in the Ukraine is going to be extremely important to where the price of corn goes in 2016. So when I look at it, we had some bad weather in China, but again, look at the top of that chart. The production was superseded by the supply. And again, this is in a very slow economic time for China, but it still shows that they're consuming. So again, people that trade commodities off the GDP of China, first of all, that number is not very accurate. Secondly, they're going to use their primary needs more than they're going to purchase durable goods and automobiles. And so the food consumption is probably going to be largely unaffected. So we're also making a turn, and this is less significant, in the livestock production area. And I've been talking about in the U.S. How much the expansion has come down in the poultry area. And we're seeing these extremely heavyweight cattle that have been produced because we've resisted expanding the cattle herd. But if you go to China, you realize they still have, maybe it's down 50 million head, but they still have roughly 200 million head of hogs, and they have now entrenched that food item within their diets. The government will subsidize that production to keep the price of pork down. If you remember, in the last inflation scare in China, the food price inflation scare, 70% of the CPI increase on a month-to-month basis was coming from the price of pork. Now, the only way that the Chinese government loses control of the country is not from the U.S. and a military battle. It's that if they can't feed and keep happy this 1.25 billion people that have become used to a better diet. That is now what they expect to have. They don't care what they had 5 years ago or 10 years ago. They care about what they had yesterday. And so when you go and travel and visit the production areas of pork in China, it's like a military operation. It's on a scale that you can't comprehend. And there are discussions out that if you look at the price of beans versus the price of pork, if it ever gets outside of a 3-to-1 ratio, if beans are too cheap, they'll buy the beans and feed the hogs. If the pork price becomes less than 3 times the beans, they will buy pork or expand production on the world market. So look at that relationship. It's very important going forward. This is not as significant. This is a slow demand expansion that's coming from the feed and industrial use that's not going to make or break the market. What comes in is that we're now using 1/3 of the U.S. crop for ethanol. When you look at this chart over the last 2 months, this is not updated. When you look over the last 2 months, this has further exploded. Okay, I've trained some of the Chinese traders. I've visited and talked to the COFCO and CIFCO traders in China, which are similar to Walmart. They are both similar to Walmart. I gave a speech at CIFCO, and I asked, they said, do you mind if we televise this to our offices? And I said, sure. And I said, by the way, how many offices do you have? And they said 1,000. I was at a feed conference in southern China, and there were 700 feed compounders. The whole second day of the conference was aquaculture. And that's something I want to continue. That's an element that's off on the horizon. It's not important at all to today's discussion, but it's off into the distance, and I will make some references to that. But ethanol is starting to be shipped to the world. We have all this oil in the U.S. We can't ship crude oil exports out of the U.S. We just killed a pipeline that would have facilitated flow from Canada through the U.S. and into the Gulf of Mexico for export to the world. So we cut that off. So that's the first element that starts to make energy prices go higher. And the second element is there is going to be more consumption of ethanol than you will expect to see at the end of this year. I have to keep making that point because it's very important. Some people will say to me, there's a blend wall, that the operation, there are some plants under construction, but I would maintain this to you. If the ethanol stocks in the United States continue to fall, you're going to see the re-stimulation, the add-on, and the efficiency come back to, and ethanol margins will expand dramatically. Okay, so this, you got to watch this as another leading indicator to the bottom in the corn market as if ethanol stocks begin to fall off dramatically. Again, here's the red meat. This is a percentage of exports from the United States. So again, what determines pork prices is how much the world needs. And you see these two big spikes, you know, those are time frames in which exports became huge. And if you coincide, that's shortly after major economic crises. And so that's when the rest of the world's demand recovers. So if I sit here today, I say we've made the trough in the global economy and we're starting to get better. So you're going to see, just like you had in those two prior periods, you're going to see a pickup in the amount of exports of pork from the United States. Here's something that's just of importance to realize, to look at the Ukraine and see how important they are to the corn market. So if you have dryness in the Ukraine, or if you have political instability, if you have some other element, it's going to be much more important than it was 5 and 10 years ago. So we feel confident that the U.S. production and the amount of world supplies of corn are secured, but we now have to involve that fundamental into the equation. Well, here's something that I think is very important. It's specifically important to the risk management panel discussion we're going to have later today. This shows you the average range of the December corn contract from January of the fiscal year to December. So that effectively is the new crop time horizon. Now, when you look at this, you can see that the volatility has expanded dramatically in the last 6 or 7 years. Let's see a show of hands. How many people think that volatility in the next 3 years is going to be lower than what's represented in the last 3 or 4 years? How many people think volatility is going to go down? Nobody. I think you're right on that. When you look at this chart, you should see also something that's important there. The $2 range in corn is a normal situation, and that a $3 and something cent range is not completely abnormal. So as I look forward to the corn market, and I see prices at $3.40, $3.50, $3.60, that tells me that you can't rule out $4, $5.20 because of what's happened here. It also tells me, and again, this is for the hedgers, if you look at the dumbest hedge from a buy-side person that has risk, the dumbest thing or the most conservative thing would be to buy a 1 year out at the money call option. And those 1 year out at the money call options might cost you $1. So when you look at the range in the marketplace of $2.50, that kind of hedge is not completely out of the realm of being a good idea. In fact, when you look at what kind of call strike price that you can purchase if we do this 30 or 40 cent slide in corn prices, that makes a heck of a lot of sense as we're going forward. So if you're not up on all the complex strategies, just keep in mind, and I think we'll have some other presentations that echo this, The amount of cost for these options are very low right now because people are not bullish. So call options are cheap, even put options are cheap because the market doesn't expect volatility. And I think they're wrong. So if I look at the price of corn, this is my projection phase. I really do believe this. I have to have a disclaimer that if we are 20 cents lower in the price of corn, I will be significantly long personally. In the United States, you have to disclose that, and so I'm disclosing that. So when you see me writing about that this is the time to make a 12 to 15, 16-month purchase, I'll be right in there along with you. Moving on to the soybean market, which is a less bullish scenario, you look at this huge amount of imports into China, and you know what I see? I'm still in the Board of Trade building in Chicago, and I still hear a lot of chatter from the traders in the industry. And every week when the exports come out, I hear the trade say, they're good, but they can't continue to do it. That's what they say every time. But yet when you look at this, this looks like a pretty well-defined pattern. So moving on, here's the El Nino component. Vegetable oil consumption in China has consistently run tremendously above its productive capacity. Okay? So this is not something that's easily changed. A more important item, though, is when you look at the total vegetable oil exports in the world, what do you have? Palm oil by these two countries absolutely dwarfs bean oil supply. So a 10% reduction in palm oil production, if it all went to bean oil, could mean an 80% reduction in the world's supply of bean oil on the futures exchange. So palm oil tends to be a little bit more volatile. The exchange is not nearly as formidable as the CME. But when you look at this, the influence on the marketplace from bean oil could be tremendous, and it could be enough to drag the soybean market higher. It could be enough to add to the bullish shift in the corn market. Keep that in mind. And also, the most important thing is that, again, bean oil should be the first. Do you know the analogy, the canary in the coal mine? They used to have birds in the coal mine, and the bird would die if there was gas in the mine. Well, in this case, the bean oil market should be your leading indicator as to is El Nino really starting to have an influence on prices. When you look at this chart, soybean meal would be the weakest component of all the markets in the coming year. So being short soybean meal and long soybean oil, I think, would be a very good idea. Being short soybean meal against corn longs and bean oil longs would be a good idea. Being long soybean meal puts would be a good idea against some kind of long call in other grains, wheat, what have you. Because this is the most oversupplied, and its feed component is going to improve, but not improve as much. What's happening here? We're crushing these beans because we have a high oil demand. Because we have that high oil demand, we're getting this excess buildup of soybean meal. So this is the weakest market within the components. So as I look at the soybean market, here's the annual range again. Look at the sizes of these ranges. We're talking $2 and $3 and $4 ranges are not atypical in the soybean market. So whenever someone says to me, what's the potential to bottom in the bean market in the next 4 months? I'm like, well, not as good as the corn, but I also know this, that the risk and the penalty and the pain could be significantly greater in the soybean price structure than in corn. Soybeans will outdistance the corn market if there is a supply shock. Now, why would that be? Well, because we're going from a completely bearish assumption in beans. If we sit here today, we have a mixed to neutral to slightly negative view on corn. I'm talking the marketplace. So the magnitude of change in psychology will be greater in the bean market if there's a problem with production. So the corn market and the bean oil market will rally first, but then the soybean market may outdistance all of them if it's a real supply side hitch. So keep that in mind. And really, anyone who wants this presentation, if it's not in your handouts and whatever, we'll email it to you. But you really need to watch this and take a look at how wide these ranges are, because many years we come in and the idea is, oh, we don't have to worry about our risk of the upside move in the marketplace. Well, I would argue with that point. So here we have the strongest El Nino since 1950. And if palm oil exports slip a little bit over the next year, due to Indonesia and Malaysia, we're going to need 4.7 million tons after vegetable oil to make up for that world demand. And that's very difficult to accomplish. So India is the next net importer. China's a net importer. Argentina's the largest soybean oil exporter. So you got to watch the government sector in Argentina. You got to watch the economy. You have to watch the value of their currency, because a lot of times Brazil, Argentina, and Venezuela, their selling and buying of grains are probably more determined by what their currency is doing and what their governmental status is than what the actual level of their supply. So this is more of a political argument than anything. So U.S. exports are just 907,000 tons of soybean oil. That number should be a shock to you in December of 2016. If we go back and look at this a year forward, I think you'll be surprised in what you see there. So when you look at soybean prices, they have maybe 50 to 80 cents on the downside. And again, like corn, in order to get that extreme, that 80 cents, we have to have the USDA putting larger supply in. We have to have talk of some pretty good production going into the ground in South America. And we have to have that economic pressure. Oil, dollar, rate hikes. And again, all that comes into what? Between now and the end of January. So it's a ganging up or a culmination, not necessarily a perfect storm, but pretty close to a perfect storm for that to happen in the soybean market. But again, it's going to be difficult to get those to come into the same time frame. So in the wheat market, wheat would fit in somewhere between where corn is and where soybeans. So the wheat market, I would challenge you, how many people remember the $26 price in wheat? Several years ago, the reason we had that was what? Was there a broad-based shortage of wheat? No. There was a shortage of one particular kind of wheat, and the market could not substitute. The psychology turned from very bearish to extremely bullish and became irrationally bullish. I remember I wrote in my comments that some country was going to bar exports because of how high the price went. And an hour and a half later, I got a call from the Commodity Futures Trading Commission, which is our regulator. And some consumer of wheat had called the government to complain that I was trying to force the price of wheat up. So it would have been okay if I would have had a bearish view. That large food company user would have been okay if I would have been discounting the story, but because I talked about a bullish story, they didn't want me to bring it up. And that shows sometimes other elements can be operating in the marketplace. So the wheat market, we have to be careful going forward that all these different versions of wheat, that not one of them has a supply problem. Because again, if we look at the stocks to use ratio, and break it down into the component wheat markets, you're diversified. If you're expecting to have higher prices, if you're in the wheat market as a producer or a middleman that has bought supply and you're waiting to sell it, all you need is one problem within those various components and you're going to have a reaction. Feed wheat is going to compete with corn, but as you can see, if corn goes down, we're already starting to see corn become cheaper than wheat in Europe. And so this is the feed wheat has had a significant windfall like it's never had in history over the last 3 to 5 years. And so now we're coming back, and I believe that a lot of feeders, when you get in the middle of a cycle, you like to stick with the same kind of feed mix. So there's a cycle coming in which we may go back to the corn market. So that's a little bit negative. So I think that the corn market has a very significant influence on what wheat's going to do going forward. Again, a very important chart. Here's the average ranges that you see in the wheat market. And again, you look at some of these, they're quite significant. So if we look at a $4.50 price for wheat and say that you can fluctuate by $1 or $2, that leaves some pretty significant upside, $6, $6.50. Again, I'm not predicting that's possible, but I am fairly abandoned that the $4.50 level is extremely cheap in this market. So don't discount that. Again, there's the chart. When we go back and look at where those lows were, what was going on at that time? We were expecting a multi-year bear market in grains. Now, we don't have that scenario, and so I always believe that whatever you see on the chart is pretty close to factory. I believe the markets. I believe the markets are showing a deflated price, and that now that we have less supply and the economy is getting better, we don't deserve to sustainably go back and trade where those levels were in 2 and 3 years ago. So here's the problem, though. If you look at the world-ending stocks and those stocks-to-usage levels, it's not a very pretty picture for wheat. So again, it's going to need help. There's more backing down from 15-year highs. I think it's important to realize going forward that the world demand is not going to stop. The El Nino could be like a freight train. It could be driving of all commodities higher, and we could also get in that same time frame, we can get into a slight appreciation in oil prices. And I'm going to give you two factors. 8.9 million barrels per day. Every week, the Energy Information Association in the U.S. comes out, and they tell us, here's what the production of oil is in the U.S. When that number drops below 8.9 million barrels per day and stays there, we're going to be in the midst of a deterioration in the amount of stocks held in the U.S. So at that point, the fulcrum in the world oil market then begins to shift positively. So then when we have a bombing of an airliner in the Middle East, we have a flaring up of anxieties in Libya, we have an OPEC minister criticizing the rest of OPEC members for not respecting the quota, that's when those particular daily factors will start to show an increase in price. So I am not confident as I sit here today that significant price gains will be seen in 2016. But I'm very confident in the next 2 months, 3 months, 4 months at the outside, that these markets will have made major lows. And again, they can always do more than what you think. I think one of my compatriots in the industry has said that the markets can remain irrational longer than you can remain solvent. And so we have to realize that. So whatever fundamental value, whatever and again, we are below the cost of production in the United States for corn. But next spring, the farmers in the U.S. who are well-heeled, who have made a lot of money and have ethanol as a backstop, they're going to continue to plant corn. Now, they're not going to plant as much corn, and they're not going to put as many inputs into the corn, and they may not buy as high-performing seed as they have in past years. But again, that's not an element that's going to explode the market. So as I sit here today, I'm like, taking a step back, we're in the midst of a switch from paper assets to physical assets. And I know this is off track, but the gold market and the platinum markets are prime examples. Production is falling, they're halting exploration, they're halting equipment purchases, and so we're going to get into a situation where we have a number of commodities that are tight. So the wheat market and the soybean market are not going to sit at depressed, deflated values if the rest of these markets, so a rising tide will lift all boats. And if you have an El Nino event on top of that, then those $2 ranges, $3 ranges, those will be shown up in 2016. So I'm not in the bear camp. I'm definitely in the bear camp for the coming 3 months. I think it's a good time to be in the industry that you're in, because that volatility allows you to take advantage of that, to make a larger margin on your operations. But again, in my mind, I'm going to be taking long-term. I'm going to try and extend my purchases. I'm going to be long. I'm going to hedge against the upside. I'm going to take action. And you have to ask yourself, do an introspection. At the end of the day, what have you learned here? And then at the end of the day, what is it that you should do to try and make more money? You got to translate that somehow into action. So don't be lulled to believe that this bear market is going to continue, because I think it has less of a time frame than many think. So with that, I'll close, and if we have any questions, be more than happy to answer those on any market.